Hello everyone, and welcome back to the channel. Today we are going to analyze one of the most important companies in the world and how, despite its dominant position, it remains the cheapest among the Magnificent Seven. We are talking about Google. To understand this clearly, we have created a dynamic chart based on the image you see on the screen. This chart will help us visualize how Google compares to other major tech companies in terms of valuation and what this could mean for the current market landscape. Through this representation, we will clearly see how the company has been valued in comparison to its direct competitors and why this gap could represent an interesting opportunity for the future. We will analyze not only Google's current situation but also how its business model, investments in artificial intelligence, and long-term profitability can influence its future valuation. This video will help you understand the factors that affect the stock prices of major tech companies and what to consider before making informed decisions in the markets. We will also see how market cycles have affected Google in the past and what we can learn from these events. In recent years, the Magnificent Seven have dominated the market. We are talking about Microsoft, Apple, Nvidia, Amazon, Meta, Tesla, and, of course, Google. These companies have led the technological revolution and have generated spectacular returns for investors. However, they are not all valued in the same way. While Microsoft and Nvidia have seen their valuations skyrocket due to artificial intelligence and digital transformation, Google seems to have lagged in valuation despite its growth and key role in AI development. It is interesting to note how investors tend to react to certain market impulses, such as the artificial intelligence boom, which has led some companies to overvaluations, while others, like Google, have gone unnoticed. Furthermore, the rise of technology has created an environment where some of these companies have achieved extremely high valuation multiples, raising doubts about the sustainability of those prices in the long term. Google, on the other hand, although still a leader in its sector, has not experienced the same speculative fever in its stock price, which could be an advantage for investors looking for long-term value. Another key point to consider is that many of these companies have seen extraordinary increases in their stock prices due to market optimism, but this also carries the risk of a possible correction. While some analysts believe that current multiples may be sustained over time, others warn about the possibility that these valuations will adjust downward if returns do not meet investor expectations. To better understand the impact of this phenomenon, we can look at previous cycles in the tech market. For example, during the dot-com bubble in the 2000s, many companies experienced explosive growth in their valuations, only to see them plummet when market euphoria subsided. Although the current context is different, extremely high valuations always carry a degree of risk. In this sense, Google has adopted a different strategy. Instead of rushing to capture market attention with flashy announcements, it has maintained a more prudent approach to its technological and financial development. This has created a perception of less innovation compared to other companies, even though it continues to lead in several key areas of the tech sector. To measure this, let's look at the dynamic chart we have prepared. In it, we compare the forward P/E of each of these companies. The forward P/E is a key metric in financial markets, as it indicates how much investors are willing to pay for each projected dollar of future earnings. As we can see in the chart, Google is at the lowest end of the scale, with a significantly lower forward P/E compared to Microsoft, Nvidia, or Amazon. But why? This phenomenon can partly be explained by the market's perception of Google. Although the company has continued to invest in innovation, the bulk of its revenue still depends on advertising, a sector that is sometimes perceived as more volatile than hardware sales or cloud services. Another key factor to consider is that Google has been more cautious in its AI announcements compared to other companies like Microsoft or Nvidia, which could be influencing the market's perception. However, this does not mean that Google is not advancing in this field. In fact, its AI division is one of the most powerful in the world, with tools like Gemini and other solutions that could be disruptive in the future. Despite this, Google has a solid history of growth over the decades. If we analyze its performance during past financial crises, we will see that the company has been able to adapt to market changes and capitalize on new opportunities, as it did with the expansion of Android and cloud computing. Another important aspect is market confidence in Google's ability to monetize its new technologies. Although its forward PE is currently lower, this does not mean its growth prospects are smaller. Sometimes, the market takes time to adjust the value of a company, and Google could be at that point where its price does not fully reflect its future potential. We must also consider the comparison with its competitors in terms of innovation. While Microsoft and NVIDIA are leading in certain areas of artificial intelligence, Google has been heavily investing in its data infrastructure, machine learning, and advanced AI models that could give it a competitive advantage in the long term. This could cause its forward PE to adjust upward in the future if the market begins to better value these advancements. Google has not been asleep. Its growth remains solid, with diversified revenues coming from its core advertising business, the cloud with Google Cloud, and its aggressive push into artificial intelligence with Gemini and other AI-based tools. Additionally, the company has been developing its technological ecosystem to further diversify its revenue streams. Its dominance in online search remains its fundamental pillar, but the company has expanded its efforts into areas such as quantum computing, developing its own processors, and strengthening its hardware ecosystem. While these investments take time to be reflected in revenues, Google is in a privileged position to consolidate its leadership in the long term. Many of these initiatives have yet to be fully valued by the market, which represents an opportunity for those analyzing the company with a future investment perspective. In conclusion, Google is currently the cheapest among the Magnificent Seven when measured by its forward PE. Despite its growth, advances in artificial intelligence, and financial strength, the market has yet to reflect these factors in its valuation as it has with Microsoft, NVIDIA, or Amazon. However, this does not mean that the market will not adjust its valuation in the future. If you want to continue exploring key market trends, don't miss our latest video where we analyze why NVIDIA has been falling recently and the slowdown it is experiencing in one of its key sectors. See you in the next video.